Hi everyone, hope you're all well. Thank you for dialing in today. For those of you that are clients, thank you for entrusting your savings and investments with Luna. It is appreciated. For those of you that aren't clients, there's still time. We're very much open for business. So in terms of the agenda for today, let me click through. Just thought it'd be useful to give a quick introduction to Luna, what we do, how we do it. As Stuart said, I think it's important to look where we've gone in terms of what's happened in 2021, and also the key market moves in 2021 as well, both from a stock market and a bond perspective. But we don't make investment decisions by looking backward. It can sometimes be useful, but we're always looking forward in terms of what's going to be driving economies going forward, what's the outlook for this year. And most importantly, how to invest against that backdrop. Now, it has been already quite a volatile start to the year, and we will be touching on that later because we've been getting quite a few questions on that, and it's important that we give our views on that. So we'll be touching on that as well. So just to introduce Luna, we are an appointed representative of Thornbridge. Just to explain who Thornbridge are, we did an exercise, and they did an exercise on us when we started 2 years or so ago now, and it meant that we could get regulatory permissions very quickly with the FCA. We will be working with Thornbridge for another 18 months or so, but then we will be going directly authorised with the FCA. What do we do? 99% of what we do is discretionary investment management. We're based in Manchester, but we look after clients throughout the UK. The investment team at Luna is very highly experienced, 185 years of combined experience in managing portfolios and investments. That investment team will be growing during this year as well. It's been a hugely successful start for us in terms of performance, the systems we use, the processes, the team that we've been able to attract, and also the assets under management that we now manage. But there's still further headway for us to go, and the team will be continuing to grow throughout this year. So what do we do? The majority of what we do is creating bespoke portfolios, so listen to individual clients' needs and wants and wishes, and then building a portfolio that's appropriate to them. As well as that, we offer a model portfolio service on external platforms like Standard Life. And also, we offer an AIM portfolio service. If you buy an AIM company after 2 years of holding it, you qualify for something called business property relief, which means it's outside your estate for inheritance tax planning. There's a number of different inheritance tax planning tools that are available, and I'm sure Stuart and the Pareto team can talk you through them. AIM is just one way of doing it. And you know, we despite the fact that Luna, I don't think we can call ourselves new anymore because we're about 2 years old, but despite the fact that we're still relatively young, we've been able to attract these fantastic awards by De Facto, which is great because what De Facto do is they come in, they look at our processes, they look at our fee structure, they look at the people involved, they look at how we manage money and the systems that we use. And they've come through and they've given us these expert rated for 2 of our services, which is the bespoke service and the NPS, which we're delighted to do, and hopefully provides some comfort to yourselves that we know what we're doing, and external parties are reviewing us, and they think that they're very happy with what we're doing as well. So that's enough of us. I think it'd be useful to just do a quick speed round of the key developments that impacted last year. And going all the way back to January last year, when the vaccination strategy only really started in the UK. It's amazing when you think back a year that vaccinations were just starting, and how quickly things have developed and progressed in the UK and globally as well, to be fair. So this time last year, we were effectively in lockdown, and as the year progressed and as vaccinations rolled out and COVID cases started to come down, we saw the easing of restrictions, and clearly that's been on and off ever since. And what that led to is consumer demand came back very strongly. People were keen to try and return to their old lives, the kind of pre-2020 lives, the 2019 world, as quickly as possible. That was supported by the fact that we've all been feeling significantly wealthier through COVID. It's been an odd recession in that every individuals have actually, and in collection, have done better than the normal recession, which means that saving ratios have been built up and we can get back to as much normal life as possible. Economic growth exploded last year. It was clearly coming off a very poor year in 2020. 2020 was one of the weakest years in history for economic growth. And 2021, because of this demand surge, was one of the strongest years on record. Was definitely one of the strongest years for 25 years or so in global terms, but one of the strongest years ever on record for the UK. And as we got to the end of last year, in November, the data that was out last week shows the UK economy is now back to pre-COVID levels. So the economy has had one hell of a V-shape in terms of the drawdown, but then subsequently the bounce back in 2021. We've got an interesting chart on this later, which just shows the impact that supply chains had on the supply side, which is noticeable in terms of just things like used car sales are surging at the moment, and used car prices are going up significantly. And the inflation figures that we saw today, that was one of the key things that was mentioned, that used car sales are increasing significantly, which is having a big impact on inflation. But the reason that's happening is because there's a shortage of chips that goes into car parts. But that's just one example of what's going on at the moment. There's definitely some supply side issues, which has been driven by COVID, but it's also been driven by just the strong demand that's been coming through. We'll touch on that a little bit later, because I think that's a really important point. And as we progress through the year, and really kind of after the summer in September time, we saw a few developments within China, which really knocked investors' confidence from investors in China and emerging markets more broadly. There was kind of three key things that China did last year, which really knocked investors' confidence. The first was they basically turned their education sector to non-for-profit, which meant that all the listed companies just saw their revenue eroded overnight, which just goes to show that when you've got a communist state that want to concentrate on what's going on with the population, that they can make changes very quickly, which can impact listed companies significantly. And the reason they did that is because the demographics in China are horrendous. There was stats announced this week that show that the birth rate in China is one of the lowest it's been for 50 odd years. There's not enough people having children. There's been a few reasons for that. One is the old one-child policy, which has now been abolished. But equally, it's just very expensive to have children in China, and education was being used as an excuse for people not to have kids. So basically the state just turned around and said, well, we'll just make it cheaper for you to send your kids to school, and we'll turn these companies non-for-profit. But again, that was a big change, and it just presented some investors' concerns about investing in China, that if they're doing this for the education sector, then they can theoretically do it for any sector. The second, and it's still rumbling on now, is the issues with the Chinese property market and Evergrande, which has now been delisted from the Chinese stock market. But there's a significant amount of debt that's been built up investing in Chinese property over the years, which caused concerns. And that's still rumbling on. I mean, we went through a property crisis in 2008. So lessons have been learned, and we can see the impact that has in terms of the impact on the banking system, but then that impact that it has on share prices as well. And then finally, there was greater intervention from the Chinese authorities on the tech sector, which is a big proportion of the Chinese market. Again, I think the Chinese authority was surprised and maybe a bit concerned about the power that the tech companies have had after COVID. So they looked to make restrictions on the tech companies, which again impacted their share prices. So there's been a significant amount of developments within China over the course of the end of last year. I mean, it's weird that we're touching on Omicron now. You'd think it would probably be higher up, but clearly it came through in November, and that really knocked investors' confidence in November. But as the year progressed, and as we know now, that this strain, this variant, is less harmful, but can spread significantly quicker. So you're seeing a lot of cases coming through at the moment, but you're not seeing the same increase in mortality or people in hospitals as you've done in previous waves. But that being said, it clearly did have an impact on markets at the end of last year. We've touched on inflation, and we're going to have a special section on inflation. Inflation did start to pick up significantly through the course of last year. For the reasons we've mentioned already, demand came back, there was supply side shortages. Whenever demand is greater than supply, that means prices go up, and that's exactly what's happened. But we're also coming from a very low base in terms of the impact of 2021, and we'll touch on it later. And then finally, the Bank of England surprised everyone twice last year. They delayed increasing interest rates in November because of what was going on with Omicron, but then they subsequently increased interest rates from the all-time low level of 0.1% to 0.25% in December. So, and that was a surprise to the market on the upside as well. We've got a chart on interest rates in terms of and some expectations from the market later on in the presentation. So we'll go through that then. What about stock markets then? I mean, we've touched on what happened in Asia, and this chart just shows what happened during 2021. We've just put the major global stock markets on here. So it starts in January, and you can see the US, which is that dark blue line there, which was up 29.9% in the year. So quite a strong year for US equities. You've then got Europe and the UK, which are these next two numbers. Again, decent positive absolute returns delivered from equity markets last year, 24.4 and 18%. I mean, that's the average year for an equity is about 8. So last year was very much not a normal year in terms of returns. It was a very strong return. On the flip side, that wasn't the case for everyone. I mentioned the changes that happened in China, and I've got the Hong Kong stock market here, the Hang Seng, in this green line. And you can see really from the summer, when all of these changes started to come through, it just impacted investor sentiment from investing in China. And you actually made a loss of 12%, or just under 12% from investing in Hong Kong last year. Emerging markets, where you're investing in Brazil, India, Russia, as well as China, were pretty much flat last year. And Japan, you can see, had a good boost here just after the Olympics, but was modest returns. Just stopping there for a second and just thinking it from a Luna perspective. Luna very much have more assets invested in the UK. That's our biggest stock market, and we'll touch on that later. So from a Luna perspective, it was a good year. Our second biggest allocation is then to the US and then to Europe. So last year was a very good year for Luna client portfolios from a return perspective, because we were focusing on those three areas in terms of the US, Europe, and the UK, and we don't have a lot in Asia or emerging markets. What I would say is a lot of those returns were delivered in the first 6 months of the year. So that up until the summer, really, you can see that a lot of the returns were made. And what's happened recently is markets have flatlined a little bit. The returns have been a little bit more modest. And obviously, we'll touch on what's happened already in 2022 in terms of returns as well, which have been a bit more mixed. So that's just the equity market. We spend a lot of time talking about equities, but it's just as important to think about the other alternatives. We manage well-diversified portfolios that invest in different regions, but different asset classes as well. So this is just bonds. There's 4 types of bonds that we've included in this chart. The first is government bonds. Now, the bit I really want to highlight here is the beginning of the year. In the beginning of the year, investors were quite concerned about inflation and demand coming back and the future path of interest rates. And you can see there that government bonds sold off quite heavily in the first few months of the year. The reason for mentioning that is that's exactly the environment that we're in now. Investors are starting to focus on the inflation figures. Investors are starting to expect interest rates to start moving higher. And this is what's happened. I mean, you can see it here from December, but that's extended into January. And that's what's been driving markets in the short term. Government bonds have been selling off in terms of their prices because the expectation is interest rates will be moving higher. It's not been a great year to be invested in fixed income in 2021. It's not just government bonds that are delivered negative returns. If you bought a corporate bond, so you're buying debt from companies like Tesco or Marks and Spencer's, or BP or Shell, you've also delivered a negative return during the year. Corporate bonds, are very priced off what happens with government bonds. They're very closely related, and you can see that with the behaviour of the two lines, that they do move in, very closely together. And emerging market bonds, which is that yellowy line, also delivered a negative return. Again, as we touched on with what happened in China, that was one of the key drivers to emerging markets being slightly weaker. And emerging markets haven't dealt or have the same vaccination success as we've seen in the UK. We quite like strategic bonds, which is the one that just delivered a positive return last year, sorry. Strategic bonds can go anywhere, so they can buy government bonds, they can buy corporate bonds, they can buy high yield bonds, they can buy emerging market bonds, they can buy shorter dated bonds, they can buy longer dated bonds. They have ultimate flexibility to go wherever they feel is appropriate to deliver a positive return. And they delivered a slight positive return during the year. It wasn't anything meaningful, but it was a positive return nonetheless. So that's the year that was. Let's start to look forward in terms of what to expect this year. As I mentioned, 2021 was a record year for global economic growth. That can't continue. It shouldn't be expected to hit record growth levels every single year. That will start to moderate this year. You can't keep the economy that hot for such a long period of time, and that's expected. Inflation figures out today. We'll touch up, we've got a slide on this in a minute, so I'm not going to really go into too much detail on this now, but inflation is definitely a key topic for the first half of this year, but it's something that is having a big impact on investment markets as well. And again, we'll touch on this later, but that has a knock-on impact to interest rates as well. Interest rates will be moving higher, again, in the developed markets this year, and we've got a slide on what to expect from that. Employment levels are back to pre-COVID levels in the UK. That was obviously helped by the furlough scheme, but it's not just the UK where you're seeing unemployment levels back to low levels. The US is exactly the same. And that is starting to have an impact on wages, and we'll touch on that as well. We can't get away from COVID. I mean, will we see another variant? Will we see continued impact on restrictions? We don't know, is the honest answer. And if we did know, I think you'd be worried. But that's definitely something that we need to be mindful of, and will impact markets through the course of this year. Of course it will. But it's not just about COVID, it's also about vaccination rates. Vaccination rates globally are only about 50%. So there's about 50% of the world population that are fully vaccinated. There's a further 50% to go. And that's key because as vaccination rates increase, you see restrictions ease and you see economic growth start to accelerate. And we've seen that in the UK, and we're in a privileged position in the UK, but that's not the same situation everywhere. And that provides support to economic growth this year, because as other countries go through what we went through last year in terms of vaccination rates increasing, then they'll see economic growth started to accelerate. And I think we sometimes occasionally focus a bit too much on what's going on in the UK. The FTSE 100, 70% of the earnings are derived outside of the UK. So it's even more important to concentrate what's going on outside the UK than it is inside the UK when you're thinking from an investment perspective. Politics, we've got a page on this as well, so I won't dwell on that too much, but politics are very much coming back into people's attention, obviously closer to home, but across the pond in the US as well. So I mentioned that this year is going to see growth moderate, and you've started to see that come through from some announcements already. That the World Bank has announced that they expect global growth to come down. One, because of this inflationary pressure that you're starting to see, but also the potential from COVID and variants that can impact. That's definitely wasn't being thought about as much until Omicron came through in November. As I said, the UK economy has been very strong, 6.9% growth in 2021, but that's fallen to 4.7% this year. Just to put those numbers in context, the UK economy in a normal year would grow by about 2%. So we're still expecting UK economy to expand by double the annual growth rate this year. So it's still good news. It's just not as strong and hot as it was last year, because it was very much the recovery year last year. When thinking about global growth, there's really only two countries that matter. It's the US and it's China. And China is very much seeing their growth starting to come down. You actually saw interest rates or the reserve ratio cut in China this week as well, because they're trying to support their economy. But Goldman Sachs have put a prediction that the Chinese economy is only going to grow by just over 4%. Again, I think it's important to put that number into context, because 4.3% looks very similar to the UK. So Goldman Sachs are expecting China to grow at a slower rate than the UK is this year. But China on average has grown by about 7% per annum over the last 20 or so years. So that 4.3% would feel like a recession to China, because they're still so used to growing so quickly. And back to that point I mentioned earlier, global economies now are getting back to pre-COVID levels in terms of where they were from an economic growth perspective. The US is already through that level. The UK went through that in November. That being said, that just means we've flatlined for 2 years. Obviously, it's been a big V. You would expect the economy to have grown. So there's still some catching up to do in terms of where economic growth could be. But as you can see from the expectations from this year, that there's a good chance that it's going to be met pretty quickly. Now, there's a couple of charts here which I find very interesting in terms of what's going on in the US, because as I mentioned, if you're thinking about global growth, there's only two countries that really matter. It's the US and China, and this data is purely on the US. On the left-hand side, this chart here shows US consumer wealth since the start of a recession. So you've got two here. You've got the current cycle, the COVID cycle, and then you've got the global financial crisis, which is this longer drawn out line. And clearly, we've got a lot more data on that. Now, this kind of proves the point that I said earlier in terms of it's been a very odd recession that the vast majority of people actually feel wealthier coming out of this than they did going into this. And there's a few reasons for that. I mean, house prices we've seen in the UK, which is one of our biggest assets, have clearly gone significantly higher. That's been the case in the US as well. The fact that unemployment has come down very quickly and people are employed, and that's wages are starting to go up. Investment markets, I mean, I've just touched on the US going up 30% or so last year. Investments going up is also a big impact in terms of consumer net wealth. And it's quite astonishing, really, the strength that you've seen of consumption. And this is a positive for the economy, because a significant part of the US and developed markets economy is people going out and spending money. So when people feel wealthier and better about things, they go out and spend even more. So that's why you're still seeing some strong economic growth figures predicted, because consumers are feeling in a very strong situation right now. And this is the US, but that's very much the case for the UK as well. So just on this to show the strength of this chart of this cycle, this wealth of getting to 25% higher than going into COVID. It took 7 years after the financial crisis to be able to do that. The wealth generation and creation over the last year is the same as 7 years after the global financial crisis, because it took so much longer to get to that point there. It's 28 quarters afterwards. That's a significant amount of time. On the right-hand side, I was touching about the problems with the supply chain earlier, and this just really highlights it, I think, very well. And this shows how strong goods and demand has been from the US. This shows what the trend was before in terms of goods and services. It was very much just kind of normal growth levels of 2 or 3%. COVID hit, they both took a big drawdown. Services went back to their original trend line. But because of the fact that we haven't been able to go out and consume, go on holidays, go to restaurants, people have been looking for goods a lot more than they would be services. So the surprise has been how strong the demand for goods has been. And supply chains haven't altered over the last few years, and it's been very hard for them to alter because of what's been happening in COVID. So that's the reason why we're seeing such supply problems, because demand has been so strong. As I said, this is the data for the US, but the UK is exactly the same. Inflation. So Stuart touched on this earlier on in the call. So the headlines, in case you haven't seen the news today, is that consumer price inflation, which is this chart, is 5.4%. This was done, these slides were done a few days ago, so it doesn't include the increase today. So that line has gone a little bit higher towards the end. That's the highest level since 1992. So we're at a 30-year high for consumer price inflation. For those that used to remember retail price inflation, which Gordon Brown used to talk about a lot, but then realised that it always tends to be a little bit higher than CPI, so decided to get rid of it for a number of years ago. That's running at 7.5%. So inflation is a very hot topic at the moment. It's not just the UK. I think there's a tendency to think we're special. We're not special at all. Inflation in the US is running at 7%. Inflation in Germany was announced today. That's also running at 5%. And it's running at these levels for all the same reasons. All these global developed economies are going through the same problems in terms of labour shortages, supply shortages, and there's global commodity prices that are increasing significantly. So, for example, in 2021, the oil price increased by 60%. Now, that's a significant increase in a commodity that is used in everyday life still, and that has impact on inflation. That being said, inflation over the next few months in the UK will continue to pick up. So expect these headlines to continue for a few more months in terms of where inflation is. That's because what's happening with gas prices, and you'll see energy prices rise again in April when the second annual cap comes through. So that's going to have an impact on inflation, and you still have a few more months of higher prices to come through from food and other costs to come as well. So we're expecting, and the Bank of England have even said that inflation is going to hit 6% in April. I saw one economist say that inflation could be 7% in April, and this is consumer price inflation. So inflation is going to continue to be higher over the course of this year. Now, there's a few reasons for that. I mean, I touched on the fact that car prices are going through, food prices, drink prices are going through. But it's important to remember that inflation was high when we came out of the last recession. And that's because demand comes back very strongly. The supply side doesn't alter as quickly. So it's not really a surprise to us that we're seeing these levels of inflation, because we saw them after the last recession. Looking forward, we think inflation probably will be a little bit stickier. Wage inflation is now starting to come through. The unemployment data was out yesterday, which we've got on a few slides. But wage inflation is running about 4% as well. And if we're now seeing 6 or 7% inflation, then that wage figure is only going to go up as well, because people want to maintain their standard of living. Here's the UK unemployment rate. This goes back all the way to the 1970s, so like long data charts to put things into context. It took 7 years from the financial crisis peak in unemployment to get back to the levels we were here. Back to what we were saying about the UK earlier, that's pretty much been done in a year during the COVID crisis. There's a few reasons for that. One is furlough clearly stopped unemployment spiking to previous recession levels. But the recovery has also been a lot stronger than people anticipated as well. And that's left the UK labour market, this is from the CBI, which is the Confederation of Business Industry, very tight. So this chart again goes back to the 1970s, and it just shows what businesses are saying about different factors at the moment. And their biggest concern is employment. Trying to get skilled and unskilled people, which this chart both shows, into jobs is one of the biggest impact, which is impacting production at the moment. So it's definitely biting because unemployment's low. So there's not a lot of people already in jobs, which means that you start to see wage inflation come through as well, as people are enticed to try and leave their job to go to a new job as well. So it's definitely having an impact. One of the other consequences and impacts of COVID is you've seen a lot of people leave the labour force. People have retired early, people are looking after relatives, people just don't want the hassle of working anymore. They've made enough money and they decided that they want to retire. Fair enough. And that's definitely having an impact, because the overall people in employment has also fallen. So that means there's fewer people after the jobs that are out there as well. As I said, and then I keep saying, the UK is not special. You can look at the same data with the US or Germany or other global developed nations. This chart is just the US unemployment rate. It's quite good actually, because you've got wage inflation on here as well. And you can see that wages have been gradually picking up, which is this grey line, since the financial crisis, but they're very much at an elevated level. Again, just highlighting the strength of the economic recovery since COVID. It took nearly 10 years, actually, 7 to 10 years for unemployment to fall. And look how quickly unemployment's come back in the US to pre-pandemic levels. And they didn't have a furlough scheme. So, you know, it's very impressive of the strength of the economy. Interest rates. At the moment, you've got interest rates at 0.25%. You've got inflation running at 5.4%. That is creating a big mismatch in terms of if you've got money invested in the bank at the moment in real terms. Probably one of the biggest taxes that you've got on the investments at the moment is money sat in the bank and losing out in real terms because of what's going on in inflation. And that's one of our key considerations for managing investments at the moment. Interest rates, you can see there, that very little blip at the end of that chart moved significantly in December last year, but interest rates will be increasing through this year. So this chart just shows you what expectations are for the market. We've got the US, which is the grey line. We've got Europe, which has actually got negative interest rates at the moment, so much worse starting place in the UK. You've then got the UK in that blue line, and you've got Japan in green. So I want to concentrate on the UK because that's what, you know, our savings and investments and yourselves will be invested in, which is this blue line. And you can see there that interest rates are expected to increase. So in 1 year's time, this was done at the beginning of the year. So at the end of this year, it's expected that interest rates will be at just over 1% in the UK. But in 2 years' time, that's going to be 1.25%. So the purpose of showing this chart is that despite the fact that we have high levels of inflation at the moment, we're not going to see the same high interest rates that we saw back in the 1980s when you saw inflation in double digits and interest rates in double digits. There's definitely going to be a pickup in interest rates, which, you know, theoretically should be seen as a positive. The economic growth within the UK is so strong that the Bank of England feel that they're comfortable to increase interest rates into that environment. That's a positive to me. But that being the negative of this situation is that 1% or 1.25% is still going to be significantly below inflation. So there's no point, in my view, having significant assets in cash, whether you be a business, whether you be an individual, because in real terms, you're still going to be losing out, even if interest rates do increase a little bit. That's not just going on with the UK. There's in 3 years' time, is expected that the ECB will get interest rates in Europe slightly positive. But you can see that the US and UK look very much aligned in terms of interest rate expectations. This is what's been driving markets. Back to what I mentioned earlier about the performance of markets in 2021. The increase in interest rates or increase in inflation was driving markets in the first quarter, which is why bonds sell off, and that's exactly what you're seeing at the moment as well. The reason interest rates aren't going to go back to where they were in 2007 or 2006 is because we're in a completely different world now in terms of the debt levels that we have as a country and as not just in the UK but globally as well. This chart shows the percentage of debt held as a percentage of GDP. You've got developed markets at the bottom of that chart in that light blue. You've got emerging markets in that green, and you've got the expectation for the International Monetary Fund, the IMF, which is that purple triangle. So the UK range these ranges since 1990 is at the upper end of that range. Debt levels in the UK are the highest they've been for 30 odd years. We know why this is. But COVID just accelerated the amount of debt that we have. So it now means that for a 1% increase in interest rates, which is broadly expected by the market, the UK government has to spend an extra 25 billion just in interest payments. So that's 25 billion that is not going to support infrastructure or wages for the NHS, etc. 25 billion just to pay interest. And when you're so heavily indebted, any small increase in interest rates has a meaningful impact on the amount that you have to pay. And the Bank of England know this. Rishi Sunak knows this and reminds the Bank of England every time he speaks, interest rates can't go up too high because the government is a massive employer in the UK and is needed to support the UK economy. And if you push interest rates up too high, you're just going to kill the economy. So that's the reason why interest rates have to stay low for long. And the base case for this is Japan. Japan has been in this situation for 20 or so years, and their debt to GDP is at a staggering 250%. I'm not saying the UK is going to get there, but Japan has not been able to increase interest rates significantly to 5 or 6% for a very long period of time because of this factor as well. I can't believe that it's taken this long to get to a COVID slide. If we rewinded 2 years ago or a year ago, it felt like that was the only thing that we touched on. So it's got to be a positive, right? I've already touched on Omicron and the impact that it had at the end of last year on markets, but also the amount of people in hospitals, and the amount of people that are sadly dying still, and how transmissionable this variant is. So I don't want to dwell on it too much, but that is definitely the risk still. The risk is that you start to see this pick up in terms of hospitalizations and deaths. Another variant comes, which is more aggressive. We don't know what we're working with still. I think we're dealing with it better in terms of vaccinations. We're dealing with it better because of the fact that we're all used to this environment over the last 2 years. We're dealing with it better because there's now a pill that you can take if you've got COVID to reduce the impact that it has. So there's definitely a lot of positives to be taken in terms of how we can deal with this going forward, which should mean that, as we were saying right early on in the call, that we can get back to our lives as normal as possible over the course of this year. But who knows is the honest answer. So we continue to watch that, and that's the unknown at the moment, because we just can't predict what's going to happen. Politics, we've already touched on the Chinese interference, but that's clearly going to be a driver to markets, and was a big driver to markets at the end of last year. The two biggest economies being friendly and cordial and having good relations is incredibly important. The trade war had a big impact on stock markets back in 2018. So it's something that we're very mindful of, and those talks are always ongoing. So it's something to be aware of. The UK developments, who knows what's going to happen over the course of the next weeks and months in terms of the leadership from the UK, but that's certainly come back on the agenda because of Partygate. Crucially, from an investment perspective, I think the impact should be relatively small. Sterling would be the one asset class that you'd see worried if there was a potential leadership contest. But the impact of that should be very minimal. So we're hoping that the UK impact on markets is going to be very low from any developments that come through. And Russia and Ukraine is very much on the agenda as well at the moment in terms of the struggle for gas and gas lines coming through into Europe. And then towards the end of this year, you've got the midterm elections. It's flown in terms of what's gone on in the US, but that's coming back onto the agenda. That's starting to have an impact on healthcare companies in the US as well. So they've started to disappoint. They tend to do slightly weaker in this environment. We still like healthcare for the long term, but that's certainly having an impact at the moment. So you put all that together, there are views of what's going on in the economy, there are views of what's going on in the world, but how do you actually construct a portfolio in this environment? The first thing really, and we normally start with equity markets because that's what people want to know. But as I mentioned, I think the biggest risk at the moment is actually financial repression. And that's because interest rates are going to be keeping below inflation. The gap between inflation and interest rates is one of the biggest it's ever been at the moment. So this problem is not going away. The vast majority of meetings that we have, the vast majority of meetings that Pareto have, are people that have high levels of cash that are now looking at these inflation rates thinking, oh no, inflation's running at 5 or 6%, I'm getting zero in the bank, what do I do in that environment? And that's definitely something that we're very mindful of as well. From an investment perspective, we've got very low allocation to cash and have done for a while for this financial repression perspective. And it's not just investing in cash, it's investing in bonds. You can buy a government bond. It yields a little bit more today than it did a week or two ago, but the returns on those asset classes going forward are still going to be low and below inflation. So in real terms, it's not a great investment for you to have in your portfolio. One of the other questions that we get quite a lot is, where are we in the economic cycle? And I thought this was an excellent chart to try and explain this. So just let me just go through this. The first dark blue line is what you see with the economic cycle. There is such a thing as boom and bust, no matter what Gordon Brown tries to tell you. We go through cycles all the time. You have an expansion, you see a peak, we go through recessions, we trough, we come through that and we expand. Stock markets, which is the red dotted line, move in anticipation of events. That's why you see stock markets accelerate and start to perform well when you're at the bottom of a market. This is probably best categorized as last year, in 2020 in March. The stock market bottomed in March, but that was technically when things were at their darkest in the UK, because that's when lockdown was starting to happen. But the stock market was moving in anticipation that we'll move through this and we'll come into recovery. Where do I think we are today? 2021 was that recovery year. I think we've moved past recovery now. I think we're now in this expansionary mode. And as you can see, when you're in expansion, it's still a good time to be invested in markets. You still make good money in markets in that environment. It's only when you start to move out of expansion and we peak out, that's when you start to be concerned about where markets are. And we're not there yet. Economic cycles can take, on average, 6 years. We're 18 months into this economic cycle. So if it's a normal economic cycle, we've got 4.5 years to go, which means this expansionary stage can last for a long period of time, which means you can make good money in stock markets for this for a long period of time. And that's the way that we think. We're thinking about the economic cycle. We're thinking about the longer term. We're getting a lot of questions at the moment about what's happening in the short term with markets. And I'm going to touch on that and explain exactly what's happening. But we're not being driven or making an investment decision on what's going to happen in the next week or two. We're focusing on what's happening in the next 3 to 5 years. And ultimately, when you do that, you make better investment decisions and you make better returns from focusing on that time period as well. So on that point, I think it might just be very useful just to explain exactly what's happening at the moment in markets and the impact that this has had. This is just what's happened in January. So why is US technology lower? Why are US stock markets lower? Why is the UK market up this year? They're the sort of questions that we're getting. What's happening to my portfolio? So let me just give you a quick 2 minutes on what's happening right now, and then we'll go into the summary. So it feels like investors have suddenly realized that central banks are behind the curve and interest rates are going to be going higher. As we've touched through this presentation, this has been our view and is a positive for a long period of time. So with interest rates going higher, bond prices have moved higher. That's meant that companies that make profits in the future have been under pressure. And you tend to think that as growth and technology type companies, because they're earning money in the future, and you bring those cash flows back to today, and that impacts the share price of those companies. So there's been a big move in a very short period of time in government bonds, but also the impact on technology shares as well. We fully understand, and we're used to it, that we go through periods of uncomfortable periods in markets. We've lived through a lot of uncomfortable periods over the last 2 years. We've lived through a lot of uncomfortable periods over the last 20 or so years with financial crises, COVID, etc. This happens in markets from time to time. It feels a little bit different this time because economic growth is accelerating and stock markets are going down. But the rationale for that is, as I said, because everyone's expecting interest rates to go up. Some of the worst things you can do is make rash decisions at times like this and uninvest in certain areas because you see short-term price falls. That is exactly what we are not doing. We're not making any rash decisions. If anything, we always see opportunities when you see times of volatility, because it gives us an opportunity to add cash to lower market levels and take advantage of these falls as well. So we're always on the front foot when things like this happen to take advantage of it. We're used to this, as I said. I mean, we've been through this a lot over the last few years. The moves that you see now in technology, we saw exactly this time a year ago, and share prices recovered. Share prices have a tendency of reacting very quickly to the downside and then slowly recovering over time. We're fully expecting that the period that we're going through now, that will happen in the future. Share prices will recover going forward. We at Luna have been relatively well positioned for this environment. There's a few portfolios and a few clients where they've gone sideways over the last 6 months or maybe slightly down, but we've been well positioned for this for the exact reasons that I've gone through. We don't really have a lot in bonds, which are the areas that are selling off. We reduced our technology and growth exposure back when the vaccine was announced in November 2020, and we've been increasing our exposure to the UK significantly over the course of the last 18 months or so as well. So, we're not saying that it's been a fantastic period for performance, because portfolios have basically gone sideways, but there are peers out there that have lost money in this environment, and we're not in that situation. So we feel that we've done slightly better in that environment. Just to touch on that and what the actual moves have been, the FTSE 100 this year is up 2.5%. It's only 2 weeks though, so we're not getting overly excited about this. The S&P 500 is down 4%. And the NASDAQ, which is the technology sector, is down 7%. So it has been, just to highlight that point, it has been a focused sell-off in the technology sector, really, in those growth names. The UK has done well because the UK doesn't really have anything in technology. The UK has a lot in banks and oil and gas. Banks tend to do better as interest rates are rising, and the oil price is at a 14-year high at the moment. So we've been relatively well defended against this from our allocation. The other important point is that growth in technology companies, let's not just think about what's happened the last month, let's think about what's happened over the last 3 and 5 years. Some of the share price performance from these companies has been phenomenal. The returns that investors have been able to generate from investing in the US over a long period of time have been excellent. And there's definitely a bit of profit taking that's going on at the moment as well, because investors have done so well. The big technology companies are significant in their terms of their allocation in US stock markets. And let's just stop and just think about this for a second. Are Amazon, Apple, or Facebook really going to be massively impacted by interest rates moving up by 1% or inflation running up by 6%? I don't think so. And I understand why markets are doing this at the moment, but when you stop and think about it for a second, it doesn't make sense what's actually happening. If Amazon or Microsoft want to increase their prices by 10%, and trust me, as a Microsoft and Apple consumer, they will increase their prices by 10% above inflation, then that should be a positive. So we still have an allocation to these companies because we're thinking longer term. We think that technologies continue to be adopted by individuals. And as we've seen, it really did support us through COVID. But that being said, valuations did feel like they got a bit stretched. And at Luna, we had taken our exposure down to reflect that. But we still like these companies for the longer term. So that just hopefully just touches on what's going on in the moment as well. Back to what we think longer term. We've got a low allocation to cash for the exact reasons we mentioned. We don't like bonds for the reasons mentioned in terms of where the real returns you get after inflation. But we manage well-diversified portfolios. We're not just investing in stock markets, so we have to look for alternatives to be able to support us in and deliver good absolute returns. Where we are in the cycle, as I said, we could be, if this is an average economic cycle, that could be 4.5 years more of economic growth. Which means that they can still make good returns from being invested in stock markets. Stock markets and then companies can also pass on higher levels of inflation a lot better than other asset classes can. We are not just invested in growth-orientated businesses that are being impacted at the moment. We have a lot of recovery and value plays. So we are very balanced in our approach to portfolios at the moment, which has stood us in good stead during this period of technology sell-off that we're going through at the moment. But that's always been the case. We don't fall in love with particular fund managers. We don't fall in love with particular companies. We stay objective in terms of what's going to drive performance going forward and not just what's driven performance in the past. We still like the UK. I feel like I've been saying this for a long period of time. The UK has been hated since Brexit. That's starting to be noticed by external investors now. The news of Glaxo and Unilever over the weekend was quite exciting. Just on that, I mean, Glaxo before the news was valued at about 70 billion, and the consumer division was apparently being bid for 50 billion. Now, that would suggest that the consumer division makes up about 65–70% of Glaxo. Well, it doesn't. So that means that the Glaxo is materially undervalued as a share price. One of their biggest shareholders is a company called Elliott Investors, who are an activist investor from the US, and they've bought shares in Glaxo because they see that the share price is materially undervalued. That's one of the biggest companies in the UK, which is potentially 20 or 30% undervalued compared to a global competitor. That just demonstrates in one good example of how cheap the UK is. And that's why we continue to like the UK, because we think that's going to be a good driver going forward of returns. And very short term, it's working in terms of the FTSE being up 2.5% when the technology sector is down 7%. We don't just invest in the UK or the US, though. We're looking at a number of different themes, whether it be buying an investment trust that trades on a big discount. There's still a lot of opportunities out there from what's happened to COVID. We like luxury brands. They're the best type of business in terms of passing on inflation. And we still have some exposure in technology, healthcare, and infrastructure as well. One thing that you should always expect from Luna, and it helps us sleep at night, and it hopefully helps you sleep at night as both advisors and clients at Luna, is that we focus on quality. We don't speculate in terms of low quality businesses, and that's something that we've always focused on. Quality is always running through our portfolios in terms of the companies we select and the fund managers that we invest in.